In one brutal trading session, hundreds of millions of dollars in crypto positions can be wiped out. And whenever that happens, Bitcoin and XRP almost always take the hardest hit. You see the red candles, you see the headlines, but what you don't see is what's actually attacking these assets beneath the surface. Today, on XRP Daily Brief, we're going to break down the three major attack vectors currently hitting Bitcoin and XRP. And the third one is the one almost nobody is talking about, even though it affects every serious holder directly. By the end of this video, you'll understand not just what is happening to BTC and XRP, but who is behind the pressure, why it's happening now, and how to position yourself intelligently instead of emotionally. Before we dive in, let me ask you something. If Bitcoin and XRP are being targeted right now, what do you think is the biggest real threat? Is it whale manipulation? Is it regulation? Or is it something even deeper, like institutional rebalancing and liquidity games? Think about your answer, because as we unpack these three alerts, you might change your mind. Let's start with the first layer of the attack, the part that most traders feel but rarely understand. When markets suddenly lurch downward, most people blame FUD or bad news. But in reality, the real shockwave usually starts long before the headlines. It starts in positioning. It starts when leverage builds up quietly in the background. Too many traders on one side of the boat, all betting on higher prices all at the same time. That's when markets become extremely fragile. Bitcoin, as the largest asset, carries the most leverage. When that leverage unwinds, the impact isn't contained to BTC. It cascades into altcoins. And XRP, being highly liquid yet still smaller than Bitcoin, absorbs that shock violently. Prices don't just drift lower, they gap, they snap, they overshoot. The takeaway here is simple. The first attack vector doesn't come from outside crypto. It comes from within. It's the market punishing overconfidence. And if you're not paying attention to leverage, you're always late to the move. Now imagine this. Whales, funds, and large players are watching the same metrics. They can see where retail is overextended. They can see where liquidations will trigger. And they don't need a conspiracy to act in sync, just similar incentives. A large player decides to sell size into a thin order book. Price drops. That drop triggers liquidations. Those liquidations become forced market sells. Those creates more downside, which triggers more liquidations. In minutes, what looked like a healthy chart turns into a massacre. From the outside, it looks like an attack. From the inside, it's mechanics. But here's where it becomes an attack vector. When big players deliberately sell into known liquidation zones, knowing the chain reaction will let them buy back cheaper later. Bitcoin is the primary target for this kind of move. XRP becomes collateral damage. The action point? Watch open interest, funding rates, and sudden volume spikes. Those are your early warning sirens. Don't wait for the crash to tell you it's coming. The second layer of this first alert is the liquidity environment itself. A lot of people don't realize how much liquidity has shifted off traditional exchanges and into products like ETFs, derivatives, and wrapped assets. When more and more volume moves into structured products, spot markets thin out. So now you've got a fragile setup, over-leveraged traders, thinner order books, and whales who understand exactly where the weak spots are. In that environment, a relatively modest amount of selling can create an outsized move. That's why sometimes a 5% drop in Bitcoin triggers a much larger fall in altcoins like XRP. It's not just sentiment, it's structure. If you care about survival, you have to stop looking only at price and start studying liquidity. Now let's shift into the second major alert, and this one goes deeper than charts. This is the pressure that doesn't show up as a red candle until it's too late. Regulation, compliance, and identity mapping. Most Bitcoin and XRP holders still behave like it's 2017. They talk about cold wallets, privacy. Not your keys, not your crypto. And yes, self-custody is important, but self-custody only protects your coins. It does not protect you. Governments around the world are not trying to crack your ledger. They don't need your seed phrase. They target something else. Classification. They want to decide what your holdings are in legal terms. Are they income? Are they securities? Are they financial instruments? Are they foreign assets? The answer to that question determines how they tax you, how they regulate you, and how they can go back in time to reevaluate your past activity. Bitcoin and XRP are at the front of this wave because they are the most visible and most liquid. When lawmakers and agencies design new laws and reporting frameworks, these are the coins they're staring at. That's where the second attack comes in: wallet to identity mapping. Every transaction you've ever done on Bitcoin or the XRP ledger is permanent. The only thing missing was a clean way to link that history to a verified identity. And that gap is closing fast. New reporting regimes, data sharing agreements between countries, and standardized rules for digital assets are all converging. Step by step, the anonymous aura around self-custody is shrinking. The ledger remains decentralized, but the holder becomes visible. So what does that mean for you? It means that in any serious jurisdiction, holding Bitcoin or XRP is moving toward being treated like holding a financial account. That means reporting obligations, tax exposure, proof of funds requirements, and yes, potentially retroactive scrutiny of past transfers if regulators decide to tighten classification. The uncomfortable reality is this: you cannot cold wallet your way out of regulation. That game is ending. Now let's connect this to XRP specifically. XRP isn't just a speculative token anymore. It's positioned as a liquidity and settlement asset. That means if it fulfills its promise, it becomes systemically relevant. And when something becomes systemically relevant, regulators don't ignore it. They lock it into the system. That's why the second alert is more dangerous long-term than any red candle. Price drops come and go, legal frameworks stay. If you're thinking seriously about your XRP position, you should be asking yourself not just, how much do I hold, but how am I structured if this asset becomes deeply regulated? Which brings us into the third major alert: institutional rebalancing, and how it quietly attacks both BTC and XRP without ever making a headline like attack. As institutional exposure to Bitcoin and other digital assets grows through ETFs, structured products, and custody platforms, those players bring something with them: portfolio rules. Institutions don't hold Bitcoin the way retail does. They have mandates, risk limits, allocation bans. If volatility spikes, if correlations change, if regulators shift stance, these entities mechanically adjust exposure. They don't care if you're bullish on the halving. They don't care if you believe XRP is the future of global payments. Their models tell them to cut risk, and they do it. That's the third attack vector: forced selling through rebalancing. When equity markets wobble, when bond yields move, when macro risk rises, institutions reduce risk assets. Crypto sits at the very top of that stack. Bitcoin is the first to be trimmed. Altcoins like XRP follow as non-core risk exposure. This means that at the exact moment when retail is most emotional, panicking, refreshing charts, watching liquidations, big money might be reducing their positions simply because their internal rules require it. You're trading feelings, they're following models. And here's where these three alerts intersect in a dangerous way. Attack 1, leveraged liquidations and thin liquidity. Attack 2, growing compliance pressure and legal classification. Attack 3, institutional rebalancing, draining demand at the worst times. All three hit Bitcoin and XRP at the same time. Price is just the symptom. If this breakdown is helping you see beyond the price action and into the actual mechanics behind Bitcoin and XRP's current pressure, consider liking this episode. It helps more serious holders find content that treats this space like a real financial system, not just a casino. Now let's go deeper. One of the most overlooked signs of a real attack on an asset isn't just price going down. It's liquidity quietly being removed from key venues. Think about XRP. If spot markets on major exchanges begin to see lower depth, fewer resting bids, and shrinking order books, Every sell order has more impact. This is especially dangerous when combined with high volatility. If enough market makers step back, or if they widen their spreads, the asset becomes easier to push around. A few large sells can create exaggerated moves. That's how you go from a normal correction to a cascading flush. When you see lower liquidity on exchanges and tighter regulatory pressure and institutional rebalancing, that's not a normal dip. That's a stress test. At the same time, technical indicators can mislead you. Oversold signals on Bitcoin or XRP often make people think, this must be the bottom. But in highly stressed environments, those signals can be traps. An RSI reading, or a stochastic indicator, doesn't know that a large fund still has orders to cut their position. It doesn't know a regulatory announcement is coming next week. It doesn't see how thin the order books are on a Sunday night. So yes, oversold conditions can lead to strong bounces, but they can also precede one last flush, designed to liquidate overconfident dip buyers. The practical takeaway: in attack environments, technical signals must be interpreted through the lens of liquidity and flows, never in isolation. Now, look at correlation. During calmer periods, XRP can sometimes decouple from Bitcoin, driven by its own news, its own adoption stories, its own ecosystem growth. But during stress periods, correlations spike. When big money sells risk across the board, nobody cares about narratives. Bitcoin down means crypto down. And assets like XRP, even if fundamentally strong, trade as part of a risk basket, not as an individual story. The irony is that true long-term opportunities are often born in those chaotic moments, when fundamentals and price temporarily diverge. But you only benefit if you're positioned rationally, not emotionally. Meanwhile, Bitcoin ETFs are introducing a new kind of pressure that most retail traders haven't fully processed yet. On one hand, they add legitimacy and fresh inflows. On the other, they centralize exposure into vehicles that rebalance automatically. If ETF flows slow or reverse, spot markets feel it. If institutions rotate out of Bitcoin into bonds or cash, ETF redemptions can create mechanical sell pressure that can drag the entire market lower, including XRP, even if nothing wrong has happened to XRP itself. This is what makes the current landscape so complex. You're no longer just dealing with traders versus traders. You're dealing with traders, regulators, and institutions all at once. And on top of all of that, you still have market psychology. Fear contagion is very real. One sharp move down creates social media panic. That panic encourages emotional selling. Emotional selling deepens the move. Deep moves trigger algorithmic selling and margin calls. That triggers more fear. It's a feedback loop. If you don't recognize that loop while it's happening, you get trapped inside it. You panic sell at the bottom. Then you panic buy when things look safe again at the top. And slowly, quietly, your stack shrinks. Not from one bad decision, but from a series of emotional reactions. Big money counts on that. So what is smart money actually doing while all of this is going on? They're not doom scrolling. They're not panicking in Telegram groups. They're studying where liquidity is leaving, where value is consolidating, where long-term holders are accumulating, and where regulation is actually heading. Sometimes they reduce risk. Sometimes they step aside. Sometimes they accumulate while everyone else is screaming, attack. They understand this simple truth. Attacks on price don't automatically mean attacks on value. The question you must ask is this structural damage, or is this stress testing an asset that still has long-term utility? For Bitcoin, the long-term thesis is digital scarcity and macro hedge. For XRP, the long-term thesis is real-time cross-border liquidity and financial infrastructure. If those theses remain intact, price attacks are storms, not endings. So what are the actual reversal signals you should watch for beyond just green candle good, red candle bad? First, watch Bitcoin dominance. If BTC dominance spikes aggressively during stress and then starts to level off, that can signal the worst of flight to safety is easing. Second, watch real spot volume returning, not just derivative noise. Healthy recovery comes with organic buying, not just short squeezes. Third, watch for stabilization in funding rates and positioning. When the crowd has been flushed out and leverage has normalized, the market becomes safer to participate in. Finally, watch regulatory direction. Sometimes, once a new rule set is clarified, even if it's strict, the market rallies simply because uncertainty has been removed. And here's the twist most people miss. In the long run, these repeated attacks can actually strengthen the assets that survive them. They create more resilient holders. They expose weak hands. They force infrastructure to improve. They drive out unsustainable practices. If Bitcoin and XRP can withstand coordinated selling, regulatory tightening, and institutional rebalancing, and still maintain their core use cases, that's not weakness. That's proof. The biggest danger is not the attack itself. It's facing it unprepared. So as we wrap this up, remember the 3 alerts. Alert number 1, internal market mechanics, leverage, thin liquidity, and whale behavior. Alert number 2, external regulatory pressure, identity mapping, reporting, and classification. Alert number 3, institutional portfolio flows, mechanical selling and rebalancing. You can't control any of those things, but you can control how informed you are, how structured you are, and how emotionally disciplined you are when the next wave hits. On XRP Daily Brief, the goal isn't to hype every move. It's to help you understand the system you're actually playing in, so that if and when your conviction pays off, you're still standing to benefit from it. This video is for research and informational purposes only, not professional advice. Consult a qualified expert as needed.